What is up, Shiliang?
What's up? Thanks for having me.
I'm here with Shiliang Tang, the CIO of LedgerPrime. Perhaps one of the most the lesser known but most incredible traders in the crypto space, because even on the show or in general, people tend to know about VC investors. They tend to about the macro guys because they have a lot of time to tweet. But when it comes to the actual trading, the market making, meaning the people that might be on the other side of the trade, that's Shiliang for you. So really excited to have you here today. And you have a wild background even before before founding LedgerPrime. You were at Merrill, at UBS, and Bank of America. You've always been kind of like the market maker. Mm-hmm. Maybe you can walk me a little bit through kind of like, how did you even get into the world of like, really professional trading, market making, high frequency, and so forth?
Yeah, of course. So went to engineering school, did engineering, pre-med, realized very quickly, did not want to be a doctor, did not want to be an engineer. And this was 2006, 2007, kind of pre-2008 crash where, quants were going berserk on Wall Street. And basically anyone that could program, anyone could do a bit of math, come on board, come to Wall Street. And so interned at a couple of quant HFT desks. Mm-hmm. And ultimately, this is 2008, very unlucky, but landed on a desk at the time that, kind of funny now, it was called the Automated Market Making Desk.
AMM.
AMM, the original AMM. But basically back then it was options, right? So derivatives, options, HFT, we're doing algo market making, electronic. And actually it was kind of the perfect time. Like the world was falling apart, volatility was rocketing. And that's when you would be, electronic market maker, right? Mm-hmm. That's when dislocations happen. So we did very well actually in 2008. I was at Merrill Lynch. We were acquired by Bank of America. Mm-hmm. And after another year and a half or so, I joined basically the exact same desk at UBS. It was called Electronic Volatility Trading. Both desks were, part of kind of the prop trading group back then, just, internal market making, trading. Did that for many, many years, about 4 years. And then kind of all the Dodd-Frank regulations kicked in, right? Mm-hmm. So no more prop trading, everything got unwound. Oh. And so I went back to Bank of America, essentially, and still did vol trading, but more on the kind of customer-facing institutional side, right? And so block trades, trading with like pensions, hedge funds, et cetera. And did that for a year before I decided to, it was about late 20s, decided, kind of getting slightly older, wanted to build something, not just sit in front of the screen and trade all day. And I founded this company called World Cover. It's about 2016, co-founded it with a very close friend from college. We stayed in touch in quant trading on Wall Street over the years. And essentially what we did was we sold parametric insurance. Mm-hmm. Took satellite data, basically packaged it into drought and like flood insurance, micro insurance products. So like an example is, hey, it doesn't rain for 10 days. Person that bought the insurance, gets a payout. So automatic, there's no assessment. You're not going to the field and assessing crop damages, right? And there was a product market fit with smallholder farmers in developing countries. Mm-hmm. And so we essentially packaged it all up, connected buyers who were smallholder farmers in Ghana, Uganda, Kenya, and basically sold that to reinsurers or asset managers that wanted risk and returns that were completely uncorrelated to the stock market or other markets in the world, right? So I did that for about 3 years and realized that I probably couldn't. I was a COO at the time. I couldn't continue to go to these countries every month and basically run this business for the rest of my life.
What drew you to it? Was it the uncorrelated nature, or was it the impact?
Yeah, I think it was a combination of both. It was kind of like I did derivatives for many, many years. Mm-hmm. I understood the math behind it. I could create these products, but I was searching for something more than just trading derivatives, right? Mm-hmm. And so I think the impact nature of it was unique and what drew me to it. Yeah. We went through Y Combinator. We raised a bunch of capital. Ultimately, it didn't work out. I left, for a couple of years before, the company decided to kind of hang it up. But yeah, I think it was a great experience, and all of it together I think really helped me to make LedgerPrime what it is today, and make it a success, right? So I think it was a very unique and wouldn't really definitely wouldn't trade it for the world. Yeah.
Awesome. So how did you then find that segue from that into the world of crypto?
Yeah, it was 2017 now. Bitcoin, crypto was always something I followed along. 2012, 2013, trading my PA, small, but when you're on a trading desk and you see this asset that's moving up, thousands of percent, it's something that you pay attention to.
Right.
And funny story, my wife and I bought some Bitcoin back in 2012. Not a lot, really not a lot at all. We had some engineering friends that were really close to it. They were mining it, et cetera. And we ended up paying well, in retrospect, pretty dumb, but we sold it. Luckily, we sold it before Mt. Gox collapsed, but we sold it and decided to pay for our wedding with it. So it kind of worked out. But then the whole bear market in 2015, 16, et cetera, happened. Still kind of paid attention, but wasn't as I was running World Cover and wasn't as distracted. And so 2017 things were heating up again, and so I wanted to go back into trading, go back into the markets, and I did a little assessment of the markets in crypto, and discovered that there was a whole ecosystem outside of just Bitcoin, right? And so could I actually port over a lot of the same strategies that I was running in traditional markets to crypto? Was there sufficient liquidity? Was there sufficient counterparties, exchanges? Operationally, how did it work? And my CTO, who now my CTO, but who I used to work with also at Merrill, we discovered that hey, I think we could actually make this work, right?
Right.
And it was very fortuitous because I had met the Ledger Holdings people. Ledger Holdings was a holding company that owned LedgerX at the time. It was backed by a bunch of traditional fintech investors, Lightspeed, Google Ventures, et cetera, et cetera. And they had this kind of a shell entity called LedgerPrime, that they were looking for someone to basically take over and build an asset management business, a market maker to market make on LedgerX, but eventually grow into an asset management business. I knew the founders, Paul and Juthika, who honestly, I owe my, kind of LedgerPrime, my career to in crypto. They, we were friends, we knew each other from college, and I came on board, and basically, my CTO and I, we launched LedgerPrime. For the first year and a half, just managed Ledger Holdings Capital. So on a prop basis, rebuilding a lot of the derivatives and option strategies that we were doing in traditional markets, building infrastructure, database, et cetera, and connectivity. And then in 2019, after kind of a year and a half of track record, we decided to go out and raise outside capital, and that's what LedgerPrime is now.
You said 2019?
Yeah.
Yeah, I was gonna say, so for reference, because not everybody has maybe even touched crypto derivatives, but even less so back in 2018.
Right.
And I think we onboarded into LedgerX. It might have been early, Jan 2019, something I don't know. So it was fairly early, but even back then, I mean, spreads were crazy, volume was very low, and you come from a world where you're doing massive size probably on equities, so assets with significantly less vol, a fraction of the vol, and a lot more liquidity. Now you're coming to an asset with massive vol and even less liquidity. How do you manage risk on that level?
Yeah, I think we quickly realized that whatever we learned in traditional markets in terms of modeling counterparties, efficient markets, just toss it out the window, right? There's a whole notion of put call parity. You have one vol surface for all your options. We realized hey, no one really is pricing these things on put call parity. And also, if you wanted to take advantage of it, the cost of capital is so expensive in crypto, with fully collateralized options in the US that it just doesn't work, right? So you can clip 2% arbitrage or 5% arbitrage, but you're in crypto to not clip 2%, right? So
because you're risking a lot more than that.
Yeah. So we realized hey, this is a new paradigm. Just it's almost I would say how I would imagine at least how trading emerging markets were in like the 70s or 80s, or they're just the early markets, right? You're almost like not trading the market, you're trading your counterparty to a certain extent. So like you understand the landscape, you understand what everyone else is doing, why they're doing it, when they're going to do it. And you know that they're not like necessarily pure vol trade. This is back then, right?
Yeah.
Now it's a little different, but back then they're not like pure vol traders from like Wall Street, like eking out pennies and like making everything extremely efficient. You figure out what they're doing, and then you optimize for that, right? And you kind of throw out the math models out of it. And you know, like you're supposed to do X, Y, Z to make money from it, but like you kind of throw that out the window, and you trade your counterparty basically. And so, you know, at least on LedgerX, right, we were, you know, quoting things with like 2 vol services. We were trading the calls and the puts differently. We knew who was going to come in on a weekly basis, who was trading like the 1 to 2 year options. You know, the miners that were either hedging or doing yield enhancement, the hedge funds that were coming in and doing like replacements, right? So getting leverage with like long data upside calls. So that's what
bear market. Well, I remember bear market was pretty big for like leaps. I just remember like it always made the headlines when some big fund bought like, you know, a year or 2 years out for Bitcoin at these ridiculous strike. Like, but back then it seemed ridiculous when Bitcoin was at 5K and you're buying a 40K strike.
Right. Yeah.
And so then I guess because you said you're figuring out based on what they're doing and why, so you're just identifying kind of like how much would this person, based on the person's expectation of the win of this trade, how much would they be willing to pay for it?
Yeah.
You know?
Yeah.
Like,
you kind of have to back out into, well, this is why they're doing it. This is when they're going to do it. Well, how much can you extract as a market maker in terms of the price, right?
Yeah.
That they would. So it's kind of like bartering, like in a way.
Right.
And like, so that was what the market, and now, you know, the markets are you know, a lot, I would say a lot more efficient still, you know, relatively in the options market, at least not, you know, as efficient as equities and FX, et cetera. But, you know, Deribit has grown tremendously. LedgerX has grown since the early days. There's bit.com. There's a bunch of like options vaults and everything. But like, and the OTC markets. But yeah, I mean, it's still small compared to, you know, traditional markets.
And so so that was what it was like 2019. You just mentioned, you know, now there's different platforms. I think the mergers of ETH as options was maybe 2020.
I would say we did some OTC in 2019, but 2020 was probably when it really started to you know, gain some steam.
Right.
Yeah.
And I think last year was the first time where not on the actual dashboards, but like OTC, you started having altcoin options and whatnot. How far do you think we are from having an actual mature options market where in the traditional world in equities, I think I don't, you probably know the number better than I, but it's something like 100x, like for every dollar in spot, there's $100 in derivatives. In crypto, it's almost the inverse.
Yeah. Right now, it's maybe like 3 to 5x the size of spot in crypto. I would say like.
Oh, so we have become bigger than spot already.
Yeah.
Okay, that's great.
But like in traditional other markets, generally you're looking at least like 30 to 50x, right?
Yeah.
So and like in crypto, there's really only Bitcoin and Ethereum that are listed and traded actively, right?
Correct.
Deribit's going to list Solana options very soon. You know, I think that'll take off, and other altcoin options will soon get listed. They're already listed on Delta Exchange, but it's not like, it's pretty thin, right? But in the OTC market, they are being actively traded. So, you know, I think we're still a little bit away, but you know, I would say we're kind of hitting the hockey stick growth part.
Got it. And what do you think leads to that?
I think as more traditional investors come into the space, people that understand and have the knowledge of pricing it correctly and using options correctly, they understand the value of it.
Yeah.
I think historically in crypto, part of the reason why options hasn't really taken off is the emergence of perpetuals, right? So like perpetuals, they came on board in an early stage in crypto. They're basically CFDs. CFDs, you know, they're legal in the U.S. and there's a use case for them abroad. But really, perpetuals really took off in crypto, and I think retail, like perpetuals, are a great product, right? There's no like expiration. It's easy like to just buy and sell it. A lot of liquidity. There's tons of leverage. You don't have to worry about expiration and rolling it. Whereas with options, you have to choose like the strike, the expiration, and like all these other things, right? And settlement. And so I think a lot of retail was drawn to the perpetual product to get directional leverage. Whereas in traditional markets, look like the Robinhood and all these options that were being traded in Robinhood, people tended to gravitate towards options to kind of get the same kind of like leverage, right?
Yeah.
But they don't have the access to like a CFD market in like traditional markets that like, retail has in crypto. And so what you saw instead was in options in crypto is more people looking at for yield enhancement, right? And so they see a high vol asset, they see a high premium, and so they end up generally looking for yield enhancement. And that there's a use case for that, but most of the leverage speculation gravitated towards the perpetuals market, right? And so that was kind of 2017, 18, 19. But as more traditional investors and funds and users of options come into crypto, I think then we'll start to see a shift and migration.
Got you. And now there's a whole new emerging subsector, which is DeFi options, meaning it's on chain. We were pretty early on that. In the early days, there was protocols like Hedge and Octus and Open and so forth. Fun enough, the early guard, so to say, never really made it that far. Open is seeing pretty decent traction, although I think they kind of switched their model where it's not even traditional options anymore. It's like pools. But I know you guys are also working with a number of different on-chain options protocols. Why do you think even the biggest ones so far, compared to everything else in DeFi, have maybe like 100 million TVL? Even good ones have like 20 million, 30 million, which in DeFi is pretty negligible. Sometimes you have a farm coming out the gate with $1 billion. Yeah. Why do you think that is? Is it just like a product market fit or?
Well, there's about like 10 of them now.
Yeah.
They kind of just sprouted. So I think one is liquidity is getting spread out, right? I think if you have like in crypto, really there's liquidity is still dominated by deribit options, right?
Yep.
And so deribit is 85-90% of the market. Most of the volume is there. I think we're at the stage where we'll probably start to see some consolidation in kind of the vaults, and we already saw some, right? I think was it Tap Finance that basically merged with CI Options, and I think collectively. There is actually a decent amount of TVL between all the kind of options vaults and the AMMs of options. But right now, the liquidity is pretty spread out. And so Ribbon and Friction, I would say, kind of have a lot relatively to the other vaults. But I think a problem is that liquidity has been kind of spread out a bit. But I think we'll start to see that consolidate over time.
So do you guys utilize that either as from the OTC provider side or even from the market neutral fund side, where you say like, hey, let's say somebody on Deribit wants to, or Paradigm, whatever, wants to buy or sell from us at this price, but hey, we could at a way better, then sell it right back on chain. Is that something you guys do, or is it still kind of hands off?
No, we definitely do it. So we're investors in a bunch of options DLVs, and we are market makers for pretty much all of them, right? We generally, like the flow. I think historically, my view at least, is that even on Deribit and many of the centralized exchanges, options wings are mispriced, right? I think because going back to what I was saying about how people generally use options for yield. What you find is the front end and the wings generally are pretty cheap relatively because there's more sellers and buyers from the market, right? And market makers know that, and so they can kind of depress the market or depress the wings a bit when they're quoting it. And as we know in crypto, there's significant jump risk in markets at least a couple of times a year. So we've historically found that markets in crypto options are underpriced, especially shorter dated than the wings. And then in the DOVs, with altcoin options, generally as a market maker who's trading volatility, we've started, initially I think people were aggressive out of the gates. Every market maker was trying to like one up each other and just like outbid and win the flow. But we've reached a steady state now where I actually think that the market has settled down, and vols for altcoins through the options vaults from volatility perspective probably are a bit cheaper depends on the protocol, but are cheaper than probably where they should be pricing in if they were on like a order book, right? And that's because market makers have kind of wised up. We know we can price it on a flat vol. We know that it's one-way flow, but that's fine, right? Like it's kind of a win-win because we're providing liquidity. The people that are depositing into these DOVs, they're not doing it on leverage, right? So a lot of people complain like, hey, they're gonna blow up X, Y, Z, but like they're not gonna really blow up because to deposit, let's say Solana, to sell like a Solana call through these vaults, you have to buy the Solana and it's fully collateralized, right? So like if you're gonna sell Solana 50% up, if Solana goes up 50%, you're probably gonna sell it anyway in the market. So why not sell a call option and generate some yield? Or let's say, Solana is gonna go down 50%, you're probably gonna buy it. And so why not sell a put option?
Right.
And it's fully collateralized, so it's not like you're gonna get liquidated or blown up. So that's fine, right? So they win, they get yield. Market makers win because we're buying cheap vol. And so, we're happy to generally continue to do that, right? And then going back to what we were saying, yes.
And the vol is cheap because of the current state of the market, which it is, or because of the DeFi products, they happen to have lower vol?
I would say cheap because, we generally these are like out of the money kind of wingy options.
Right.
We can generally, what we find is depending on the vault, but a lot of the times we can actually win now some of the auctions, pricing it below, let's say, realized vol. Historically, options should trade above realized vol. Implied trades above realized, but a lot of the times we actually find that now they're trading below realized. And then it's not even accounting for the fact that like you're buying wing options, so generally there should be a smile. Because out of the money options, when the market jumps, historically the volatility should be higher, right? So you're able to buy it for below realized, and you're able to buy it on a flat vol surface. But we're providing liquidity, like it's a thin market, like there's not any. It's not like as a market maker there's risk to us, right? Like there's no out for us. It's not like there's a liquid Avalanche or Phantom or Solana exchange out there that we can lay off this risk. We have to warehouse it, and these are like weekly options, so we're warehousing this gamma risk and this data basically. It's just decaying, every day for a week, and that's it. So there's risk to both parties, but I think the market is reaching an equilibrium where we're buying it cheap enough, but we're getting compensated for the risk that we're housing.
Okay, so when you say warehousing the risk, you said like for example an option, you said an option on Avalanche, the token on the AVAX token, right? Yeah. So do you hedge that at all? Like by, let's say, like if you're...
We delta hedge it, right?
Gotcha.
So like when we're trading the volatility, we basically gamma hedge. We're scalping like the realized versus implied vol. Sometimes if we buy it cheap enough versus, let's say, Bitcoin or Ethereum, we might spread it off. So we find ourselves, let's say, long Solana vol and then short Ethereum vol because the spread, for some reason, implied relatively has gotten cheap or expensive. And so we can do a relative value, implied vol trade. But most of the time we have to hold it into expiration. So.
Gotcha. Right. Yeah. Cause I was going to say, like if I, let's say we take it back to May of last year, Luna was at $4 at that time, and we bought a lot on spot, but let's say, for example, I said, hey, Shiliang, I want to buy a ton of Luna calls. And maybe, let's say you chose to do so. It's not like this. At that time, it wasn't a big market, and Luna went from like $4 to $85. Yeah. What would be your process for, like, as a market maker and also like running a market neutral fund? Like, how do you hedge that risk out? Like, practically speaking. So, like, you now wrote those options for a million Luna token, let's say. Yeah.
So this is something that I learned as an electronic market maker, but more so on the institutional side, just for that 1 year. So we were obviously making markers for very large funds, right? These are like the Brevan Howards of the world.
Yeah.
Very, very smart fundamental investors that had an edge in theory and would buy options, trading earnings or events, et cetera. And so what we learned quickly was who are the smart investors, who are kind of the investors trading vol, why they're doing it. And when you're a market maker, you want to trade against either the dumbest investors or the smartest investors. You hate the investors that are 50-50 because you don't know they're actually right or wrong. But if they're the dumbest, well, you can just make the market for them and you're always going to win. But if you're trading against the smartest investor, you're always going to lose. Well, you can now just take the same position as they are. So let's say you sell Luna. Let's say I know that you're like the best investor, and you're getting extremely bullish Luna calls.
Yeah.
So okay, I want to maintain a relationship with you because I want to know what you're doing always. And so I'll make an option like a market for you. I'll sell you Luna calls all day long, whatever you want, and I'll sell it to you. And then after I sell it, well, I'm gonna basically delta hedge the calls on like a 1 delta and buy as much Luna spot, perps, futures, whatever as possible. So like if I'm selling 1 Luna call, maybe I'll buy like 2 Luna like spot, like physical, right? And basically get along with you, knowing that like, hey, like, you're smart, you've done the work, and clearly like you have a good thesis. I'll probably spend some time learning about it, and if I agree, then I have conviction as well, right? And I'll sell you the option, that's fine. I'll lose on the options, but I'll make more, basically buying like the spot or purse, whatever, as a hedge in the same direction as you.
Right, because essentially, like, if it is a direct relationship, the counterparty versus, let's say, something like Paradigm where you can anonymize it, where you wouldn't know that who's behind it.
Exactly. So trading like anonymously is really not great, right? Like there's no information on the flow. We bake it into the edge, but sometimes I'd rather be wrong than like trading in a market where it's like a coin flip, basically, right? So.
And I mean, with people can say they're good or bad, but with every trade they put on with you, you get a better idea of like, how consistent are they? And if they're like a, 5-year counterparty and like they're really consistent or they have some really big home runs, then like, I mean, that's pretty much free alpha for you too, where you say like, hey, you know what, I'd rather do, also go long on Luna. I sell the calls, I capture the premium and, wherever the strike price is, that as well. And what's the risk, is of course like if Luna tanks, but some of that will be mitigated by the premium you collected.
Right.
And again, like you have information that others won't have.
Right. Yeah.
Which have you ever? So you said you're you said before we start rolling that you're more like a multi-strategy fund at this point.
Yeah, I mean we're a hedge fund, right? We have outside investors now. Yeah. We took some of the holding company capital in 2019, and then we raised much more additional outside capital. And so we're multi-strat, but most of our strategies are quantitative and systematic and market neutral. And so examples, as I'm sure like market making, arbitrage, basis, cash carry. We do a lot, obviously, in options, electronic market making, as well as OTC market making. Past year and a half, we built out DeFi as well. So like DeFi, CeFi arbitrage, yield farming, liquidity mining. And then a small portion of our book is like early stage, like venture, right? So like more like partnerships, venture, but basically things that complement our market making and liquidity provisioning strategies.
Like you mentioned, the on-chain options, where it's like, well, you're already doing it as a business. Right. There's a whole new venue where in the ideal case scenario, you're able to market make for them, make money in the market making, and flush it with liquidity, gains in venture value.
Exactly, yeah.
Right.
So like we noticed early on in DeFi was like when we were first just building out the pipes and providing liquidity on these projects, was a lot of these projects, really all they needed was market makers and liquidity providers, right? To bootstrap their liquidity, bring on customers, clients, etc. And so it made sense to align interests to either just invest in them, and so we benefit from both, or to basically, do some sort of market making deal, right?
Yeah. So the reason I segued or I asked about, it being a multi-strategy fund at this point is like you have this great access to alpha. You've been counterparty to almost most big crypto shops, or if not all, over the last 5 years at some point between, 17, 18, 19, 20, 21, 22 now, 6 years, something I'm curious about is why market neutral? I mean, like I personally, I love crypto. I'm long as hell because I think that's where the big money's made. I don't know what the returns look like on market neutral. I've heard some people make 30, 50, which is great in equities, but in crypto, what makes you want to leave the directionality on the table?
Yeah, honestly, in retrospect, I probably shouldn't have done a market neutral fund when I first launched in 2017. It was probably like pretty stupid, but it was what I knew, right? It was kind of like what my CTO and I, we were quants, we're systematic. Like we never came from like the fundamental investor world. We didn't come from like the VC world. So I couldn't, I'd be lying to myself, my investors, if I really knew that space well. And so we looked at the landscape, we saw the opportunity, and we decided to do it, right? And so one, I would say that all strategies have some directionality, right? Either first order or second order. So like if you're a VC or long short, you have directionality in the first order. If you're a market neutral fund, you still have some directionality, right? What you notice in crypto is, hey, when markets are going up in a bull market, volatility is higher generally. And when markets are going down in crypto, generally volatility is lower. When you're running a market neutral fund, typically you're exploiting inefficiencies in the market. And generally, those inefficiencies are enlarged or more prominent when there's a lot of volatility. And so really, we do still have some directionality, right? We do tend to do a lot better in like bull, volatile markets, as opposed to like markets now where it's kind of just dead and flatline.
I was going to say, I assume that there is, and correct me if I'm wrong, there's probably more option buying in the bull and more riding in the bear.
Yeah, definitely.
Because people are looking for like some yield right now. They're sitting on it anyway. Versus in the bull, people are so the greed kicks in. Where I've seen insane. I think on Deribit I've seen like ETH at like 250 or something like that, and now it's at 60. I think.
Yeah. So like January 2021, right? That's when Bitcoin kind of blew through. Like December, they blew through 20K. January blew through 20K. Started running up. Like a ton of just like 30 to 40K calls were printed on Deribit, like massive. That actually helped drive a lot of the, I think, spot movements, because market makers were sold. We had to constantly chase and hedge, and the market picked up on it and pushed it higher. But yeah, as the reflexivity, right, of crypto is like no other asset class. And, with it, like when the market is going up 10, 20, 30% a week, you don't really care about market efficiencies or like pricing options correctly or like spot arbitrage, whatever. Like if you're a fundamental investor, like you're just slapping up trades left and right, like buying, rolling, taking profit, like who cares, right? But as a result of all that action, it creates a lot of market inefficiencies, and so some of the HFT guys pick up on that, and so the profits are generally wider during those time periods as well.
Got you. And that's actually a great segue into another topic I want to discuss with you, which is, I think, one of the core features of crypto right now is unfortunately interest. I mean, like when people think of like what can I do with crypto today, it used to be stuff like Aave Compound. Now it's Anchor, yield farming. Literally one of the core products of crypto so far is that like, hey, I can get 20% on my stable coin, right? Unfortunately, I hope soon like there will be many more killer use cases. But one of the core killer use cases that catches people's eyes is the interest rates. And a lot of times, the question I get from LPs or even just people in general is like, where does this yield come from? And so because you said there's so much reflexivity, we've seen so many sources, whether that's the grayscale op, the basis trade, Anchor, farming, and so forth. What do you think is the core source of the net interest rate we have in crypto, and how sustainable is that right now?
I think, so I think it depends on where you're looking, right? I think if you're looking at like the centralized exchanges, and you're looking, let's say, take an example like March, April, May of 2021, when the cash carry rate was like, for Bitcoin even, was like 30%, Ethereum was like 40, 50%, right? Basically, you could just buy spot, sell futures, and lock in like 30 to 50%, right? That's insane. Like basically risk-free. Well, there's a reason why like futures were getting pushed out so much relative to spot markets, right? I think a lot of it was due to, so in general, historically, there's been a net shortage of cash in crypto, right? People always start for cash.
Explain that.
So people generally want more leverage.
Okay.
Right?
Oh, leverage. Gotcha.
Yeah. And so, well, if there was ample cash and lending and like cheap capital in crypto, well, people can just borrow that and basically buy more spot. But because there isn't that, well, they have to kind of go to the derivatives market, and they have to buy perps and get 5x, 10x, 20x leverage, or buy futures and get equally amount of leverage. And so if you're doing directional and you really think the market is going to continue to go up, well, then fine. I'm willing to pay 10, 20, 30% annualized interest rates, basically, to get that 10, 20, 30x leverage, right?
Mm-hmm.
Because I really think the market's going to go up 50% or 100% in a year. Fine, I'll pay 20% of interest or 30% of interest, right? And that's fine. And we saw that in the bull market because markets were actually going up 100% or more, and people were willing to pay 20% interest for that basically leverage on exchanges.
Mm-hmm.
So if you're looking at looking at centralized exchanges, then that's where a lot of the yield comes from, right? And like there's also discrepancy between U.S. leverage and Asia leverage, let's say,
Mm-hmm.
right? Like if you're looking on Deribit, yeah, it was 30 to 50% futures over spot. If you're looking on CME, it was a little bit less, maybe 10 to 20%, because in the U.S. the cost of capital is so low,
Mm-hmm.
very very cheap back then. If you're a traditional market fund, and you see the CME Bitcoin futures trading 10 to 20% above spot, and it's regulated, and you feel comfortable enough, and you have the infrastructure to trade it, then perfect. Like I'm gonna make 20% a year on this. Like this is amazing. But if you're in Asia, right, and your cost of capital is so much higher, and your hurdle rate is not like 2% like free money. Your
Mm-hmm.
hurdle rate's more like 10 or 15%. Then you're not really going to care about like some 10 or 20% like arbitrage, right? Cash carry,
Sure.
right? You're going to like it doesn't matter. I'm going to do yield farming. I'm going to do something else that's going to make me 50 or 100%. And so there was less supply of capital in like Deribit and these like offshore exchanges versus like a CME, right?
Yeah.
And so you started to see this difference in CME markets versus Deribit markets for like cash carry rates. Well, now, I mean, it's all dead, right? Like, well, it's a bear market now. Like, people care a little bit less about cash, and so, and also like traditional money flowing into the ecosystem really crushed the kind of like cash carry rate. But back then, that explained like, so on centralized markets, that's where a lot of the yield is coming from. Now, if you're looking at DeFi, well, I think a lot of it comes from VC money.
Mm-hmm.
So like. Yes, there's tremendous use cases from like AMMs, and there's fees generated, but I think a lot of the newer protocols, when they first launch and they're able to come out and say like, hey, it's 40, 50, whatever percent, even in stablecoin pools, yeah. I think a lot of it is basically, capital that they're kind of fronting themselves. And
Mm-hmm.
where does that capital come from? Well, it comes from investors, right? And so it's fine, right? There's nothing necessarily wrong with it if they really believe that it is a product that will reach some escape velocity, but you're basically, doing kind of upfront marketing for it, right? And so you're trying to attract capital from whatever users, people that want to throw into a pool, or people that want to like trade on the exchange. Like you have to attract them somehow, right?
Right.
And so you have like just as one way to do it is basically high yields, right? And so. That if you're looking at DeFi, well, you can say that a lot of it, yes, it comes from fees in the longer term, but a lot of it really just comes from VC capital that has pushed up the token price to a certain extent.
Yeah, I mean, like I think there's two big elephants in the room. Well, one is kind of like irrelevant at this point, but it was like BlockFi, for example. I mean, it's very. And I mean, none of these you have to comment in case you ever, because I know crypto is a very small world, but yeah. Like. With BlockFi, for example, back in the day, they gave you like 6% on Bitcoin. I think, well, actually pretty normal stablecoin rates, but I just like every week I get an email from them. It's like, oh, we lowered it. And you kind of know that, it was just VC money that made that 6%. Because why? How do I know that? Because, well, there's no fucking 6% on Bitcoin anywhere. So where does it come from?
Right.
And then the actual bigger one that's more present now is Anchor. Anchor is we Luna was one of our biggest positions. I was a fan of Luna. I kind of am a fan of Luna. The only thing is that there's certain again, like everything comes from somewhere. So the question is where does Anchor yield come from? Well, it's pretty simple. They're putting Luna into the Anchor reserves, and like it's getting spent at I believe 10 million a day. Something along those lines. I mean, they're burning through over 100 million a month right now. It's almost depleted the almost $4 billion they put in there. So, where do you see and right now people love that in the bear market because they say, well, everything is going down, so I might as well use T and earn some yield on it.
Mm-hmm.
Where do you see a bottom come? Like, because you've seen cycles before, you've traded 2015 bear market, you've traded the 18 bear market. Visually, maybe you can describe how does the relationship of leverage and market cycles look like? Like, is there a certain point where you say, like, hey, based on funding rates or based on the demand for leverage in general and open interest and so forth, this is usually what a cyclical bottom looks like, and maybe what the cyclical top looks like?
Yeah. Yeah, I mean, one I would say, like, just touching a bit on the anchor part, is 20% is kind of just arbitrary, right? Like, if you think about it, it kind of just...
It's marketing.
Yeah, it's just, you know, it could be 15, it could be 25, like, somehow the market fixed it on 20.
I think it's because, like, I think there was some curve pools that had, like, you know, 13, 14, 15, 16.
Yeah.
You had to be higher than that.
Right. And... But the whole ecosystem, I think, as a whole, and it's healthy, right? I think everyone's going to realize that, like, 20% probably is not like sustainable long term, but also a market neutral fund. Like, when we first started, our target was basically, you know, 30% net, 3+ sharp, right? Like, sure, the market, we've done a lot better than that over the years, but, like, over the long term, we knew that probably even that was not sustainable, right? Because, like, traditional models are going to come in, sophisticated capital is going to come in. Like, a 30% market neutral fund in, like, equities is, like, you know, over many, many years is, like, unheard of, right? And, like, we've already seen it, like, spot arbitrage largely has disappeared. Cash carry rates have gone down from 30% to, like, 5% now. And, like, even DeFi yields across the spectrum has come down, right, everywhere. So and actually, I think that's healthy in the sense that, like, we're resetting market expectations. As traditional money is coming to the space, it's also resetting expectations in terms of, like, what people are okay with as a return target. And I think in a way, you know, that might actually save the whole ecosystem because we're not going to be so striving and, like, really needing, like, to do everything that we possibly can to, as a fund, hit 30% or as anchor hit 20%, let's say, right? I think, you know, there's going to be a point in time where everyone's going to take a look and, like, hey, like, there's a lot of money in this space now. It's becoming a mature asset class. It's going to trend and converge with traditional asset classes. And the traditional asset class is not asking you to consistently make 30 or 20% every single year, right?
But is that what's happening? I feel like it's almost going more in the opposite toxic direction where you have, let's say, Tron say, you know what, we'll do 30% USDD. Let's go, right?
Yeah.
So here's $10 billion. I don't know where they got the 10 billion from. They probably dumped a bunch of TRX. And saying we're backstopping at 30% interest rate with 10 billion, right? Because 20 clearly wasn't enough.
Right. Well, you got to do 21 or something. No, that's a good point. I think, you know, there's always going to be another project that tries to run up. There's always going to be a corner of crypto that is going to kind of, like, I don't know, excuse me, like, balls to the wall. It's just, like, as much, like, leverage or whatever as possible. But on the whole, I think as the space becomes institutionalized, I think that, you know, it's healthier in terms of, like, the lower kind of expectations, right? In terms of, like, a bottom in the market, 2018 was brutal. You know, and 2018 was, like, there was no DeFi. There was no really, like, much of options to be traded. There were, you know, some perps, but, like, not a ton of perps. So, like, you know, you were kind of just sitting on your hands, right? Like, there were some interesting events, like the Bitcoin Cash, whatever, Forex and events, etc. But, like, unlike now, like, yeah, it's a bear market, but, like, at least there's 10 different things that I can look at and, like, keep myself busy with, right? Like, back then, really just punting around, like, Bitcoin and ETH and maybe a couple of alts and, like, not even much of a, like, derivatives market, and that was kind of it. So, you know, I'm not sure, like, it will, you know, nothing's kind of like a carbon copy. But I think that until we start to see crypto kind of, I mean, it's a risky asset, right? I think it's proven itself to a certain extent. It's a risky asset. It's the correlation right now is pretty high, right? Until we start to see that bifurcate a bit, and maybe we never will, unfortunately. But until we kind of see that bifurcate a bit, and if it doesn't, then until we kind of see a stabilization in macro assets and markets, it's going to be hard to kind of call a bottom, right? Because like it's gotten to the point where you can't have the best of both worlds. You can't like be like, hey, the institutions are coming and like great, like open the floodgates, like please come in and legitimize this asset class. But then now you have Tiger Global that's basically in the space, and they're in crypto, they're in macro assets, et cetera, and it's one book, right? And so they have to rebalance, they have to hedge, et cetera, et cetera. And so when you mix crypto as an asset with other assets and it's the same pool of capital, unfortunately that also means that the correlation is probably going to increase, right? And so it's trading more like other assets, and so for it to be a bottom, if you're just talking about Bitcoin, Ethereum, which are kind of the largest assets, until kind of I see a kind of a bifurcation of how it performs and trades versus macro, or until macro really stabilizes, then it's gonna be hard, right? But I think like now we've again, unlike 2018, where correlation won across everything, we're starting to see a lot of projects still perform pretty well in this environment, right? Like single project names, idiosyncratically, that are doing a lot better than the overall kind of crypto asset, right?
I'll say
like,
for you, Maple. I know
exactly. Maple's great, right? And there's there's Lido, there's like a couple of like the Terra ecosystem projects and others, right? And that's great. I think that's another sign of a maturing asset class as well. And that's why you have a great fund, and that's why like there's long short guys in the space now, and because there are opportunities like this, unlike in 2018, where really like unfortunately
because now there's real products, right? Where there's real products, real customers, real money flowing, and it's no longer just a bunch of white papers. And so like if a unique team is actually shipping and just crushing milestones, then why shouldn't it attract more investors and more more traction? Now, while it might be hard for you to identify that like on a macro scale, maybe we can like size it down more to like individual instances. We both traded through some crazy liquidation events. We had the COVID crash, which was just all asset classes, but then also I remember, and I think we hung out like right around those days in like May, April of last year, where we had at the time it was the biggest liquidation event in crypto history, I believe, with like 19 billion wiped out in a single day or something along those lines. I remember on some of these assets, like DeFi got hit brutally because people were just like chanting that like DeFi was coming back again, like the next DeFi summer. Like YFI, I think, went from like 50 or 60,000 to like 90,000, and then cascaded down to perhaps 10,000. And then there was like singular wicks where within like 20 minutes, some of these DeFi assets lost 30, 40, 50%. Both as a trader and also as a market maker, like there's two parts to it. So we'll start with one of them. How do you manage the psychology of it in those moments? And then the second part is like from a mechanical perspective, like the fuck do you do, right? Like what do you actually practically do when on a 5-minute chart you're making 10% moves?
I think I learned a lot. So like, yes, we've been around since 2017. In 2018, like yes, the markets were volatile, but there weren't as much, I would say, derivatives in the ecosystem back then as there is now. 2020 March, in retrospect, what we did at the time was we basically shored up our balance sheet, right? We didn't know what was going to happen. We kind of, the fund was kind of with year one of outside capital. We just kind of hit the 1-year anniversary. And we basically pull back a bit, right? And in retrospect, it was probably a mistake. It was a great time to be a market maker at HFT. We probably should have pushed more of our capital across the ecosystem, even levered up and taken advantage of it. But we didn't really know what the system, like the risks of a collapse. And so we kind of pulled back a bit. made sure we weren't over levered. We were seeing like derivative liquidation funds was depleted. We were seeing like BitMEX was like completely down,
frozen, right, with like adaptive.
Yeah, we didn't know what the collateral, like lenders and borrowers could have been and they probably were in default. And luckily the market bounced very quickly and saved, I think, a lot of borrowers actually. I think if the market stayed down in the 3K, 4K area for months, I think we would have seen a ton more people default. So we didn't know what the collateral damage was, and we just needed to shore up the balance sheet and our investor capital, and so we kind of pulled back a bit. But I think those are all learning experiences, and so in May of 2021, when it happened again, right? I think we felt comfortable enough looking at that event that like, hey, like the market is way more mature now than it was in March of 2020.
Way less macro headwinds too.
Yeah, way less macro headwinds. Insurance funds like healthy, borrower lenders, generally ecosystem way healthier. Like we just gotten through like a massive bull run the year before. Balance sheets are healthy. This is kind of just like an idiosyncratic liquidation event of like leverage flushing the ecosystem. But it's fine. We'll survive from this. There's no like permanent damage, right? And so, during that time, I think having learned the lessons of March 2020, we, stayed out in the market. If anything, we would kind of increase our footprint, and it worked out, right? And so, I think there's kind of positive and negatives of leverage and liquidations and everything, but you kind of have to recognize like it's like situationally, right? Like where we are. And honestly, like just taking a step back, like liquidations as a strategy in crypto is probably one of the most lucrative strategies like ever, right? Like since the beginning of time, since perps, it's been like very, very like profitable, right? And now with DeFi, like as margin and leverage start to be created in kind of the rails on DeFi, you need liquidators. And again, as right now it's not as often, the volume isn't as much, et cetera. But like if it ever becomes, as liquid or traded heavily as traditional markets, then liquidations and liquidators are needed on DeFi, and it's again going to be extremely profitable strategy.
Right, and especially since leverage is becoming also more systemically like integrated with DeFi itself. Early movers in that was like Alpha Finance, where it's like leveraged market making essentially. You have what's called, even with Luna, you can like with B Luna you can borrow against it. People put it into Anchor, and then so like they're literally borrowing Luna to get the stable coin that is backed by Luna. So the instability of Luna itself makes UST less stable. You have there's just a number of and I think we talked about it a little bit earlier. What's called we talk about this all the time. Reflexivities. A lot of reflexivities in DeFi. Do you expect a black swan in this cycle still, or do you think like most of the shock has been done and now we're more in a slow bleed phase?
You're talking about the general kind of like
just the DeFi. Yeah. Well, no, more so DeFi, like DeFi in general. Like, do you think something like, for example, like the Curve War, CVX, or Anchor, as we talked about a second, like, are those big, like, especially a Curve with, now there's 4-pool and like, there's just so much Ponzi-nomics going on with these new stable coins. Do you think that can have a big enough impact to have an impact on crypto itself?
Yeah.
And also, what would be the opportunity, since you said liquidations is a great strategy?
Right. I think if we, and fingers crossed, I don't think the macro environment is, yes, it's looking dire right now, and absent of some sort of like, at one point I guess with kind of everything that was going on like Russia and Ukraine and everything, but like outside of that, I'm more optimistic that we won't see another March kind of 2020 crash again this time. I don't think the market has bottomed. I think we will see a bit more corrections, I think there's going to be a bit more pain ahead, both in macro and thus also crypto. But I'm not expecting like a wick down to like 10K or whatever, right? But if we were, I do think it could get very like interesting for many DeFi protocols, right? And I think
interesting.
I mean, the easy ones are like what will happen to Terra, right?
Yeah.
Like there's a lot of money behind it, right? Like it's not just like the Terra ecosystem. There's a lot of traditional money investors that have a lot of balance sheet that have that really want to see it succeed and not fail. And so like if you're going through these different lines of defense, like that's a lot, right?
Yeah.
So really will take a systemic shock that would prevent these large players from deploying capital to really buffer up these different ecosystems for it all to kind of crumble down, right? So I think it's not just what's already there, but like there's a lot of crypto firms and traditional firms out there that have a lot of money invested in these kind of projects, and when push comes to shove, I think we already saw it with Wormhole, right? They will step in. So like for it all to fail, I think you need something that would prevent them, and that would be some large macro unrelated to crypto.
Gotcha. Yeah, so you pretty much need somebody that will stop the Tigers and Banes and A's and Z's and so forth to not backstop, which is currently happening.
Yeah.
Earlier you mentioned that essentially like it's the desire for leverage, desire for cash, so to say, that is causing bull markets, bear markets. Or I want to figure out is it that bull markets cause a desire for cash, or is it the desire for cash that's causing bull markets?
Yeah, I would say it's not the desire for cash doesn't necessarily cause bear or bull markets, right? It's kind of a symptom of it, right? In a bull market, everyone's kind of like cash stopped, right? Because like we know the market's going to go up, and so you just want to get as much exposure as possible, both in terms of directional, but also in terms of market neutral funds, because we just need balance sheet to like do all the strategies and take advantage of everything, right? So like everyone wants cash. So it's more of a symptom. I think over the longer term, between bear and bull, I think it just comes down to a transfer of who's holding the assets, right? It's a cycle, right? You go through investors that put a lot of money, and then the token gets launched, and yes, different investors have different time horizons, and retail investors obviously have a different time horizon as well, and for like kind of a market to kind of bottom out, as you essentially need to flush out the kind of shorter time horizon kind of investors, right? And that's fine. That's part of like the nature of cycles and markets and everything else. Right?
But so that's the question then. Like where do you see that now? I know you said you think there's still more pain ahead. I think when I looked at UTXO of Bitcoin, for example, last, I think we're already at an all-time low of sub 1 year holders.
Yep. Yeah, I would say Bitcoin is actually pretty, like, it's surprisingly done very, very well relative to like the NASDAQ and some of these like large macro assets, right? And yes, even on chain, it's actually very, very healthy. And I think like, just looking at Bitcoin, I think it's done extremely well, and it's actually pretty healthy. But when I look at like a lot of the, let's say non-Bitcoin or Ethereum, other like token projects,
especially L1s have really gotten mainstream recently.
But also just the projects, right?
Gotcha.
Even on top of it, like like these are like the 2020, 21 vintage projects, right? There is a lot of unlock that are happening.
Sure.
There's like 10 to 15 projects in every single like subsector out there. Not every single one of them is going to win, right? And so unfortunately, that those projects probably will just die a slow death over time, right?
Right. Yeah. Our internal joke is that like we really don't need the 4th DEX on the 13th chain. Which there's like there's 5 DEXs on every single layer 1, and like it doesn't even fit on one page of DeFi polls anymore. So
and like the thing that maybe kind of scares me a bit is the 2017-18 vintage. back then a lot of projects didn't even have a concept of like an unlock, or
Mhm.
like it was a pretty short unlock. And
Mhm.
so like, okay, everything unlocked at the same time, flush and like wipe clean everything, and that's it, right?
Mhm.
Whereas like now, everyone kind of wised up and was like, hey, you got like a 3 to 4 year unlock, right?
Linear vesting every
Right.
month. We're getting some more dumping.
Linear vesting, whatever you want to call it. But like that just kind of slows the bleed,
Yeah.
or the inevitable. And so, well, in 2018, everything flushed pretty quickly. I mean, it still took a couple of years, but now we have the cycle of many, many years of projects that are just going to like, with no traction or no team anymore, are they just going to like, be a weight on the whole ecosystem for like 3-4 years, right? Yeah.
But with the emergence, specifically with what you offer as an OTC desk, how much of that do you think is already priced in, since you are able to, for example, like short against your bag on FTX, you're able to buy puts on it.
Yep.
For LedgerPrime,
Yep. Yeah, no, definitely. I think a lot of it, if there is a liquid, I mean, I think looking at the data, you kind of see like a difference between token projects that have a perpetual or futures market versus a token project that doesn't, right? I think like as a perpetual emerges, it enables you the ability to hedge, and often you see with those projects, you actually see like those projects kind of like, unless they're like the leader in their subsector, you kind of see those projects like underperform to a certain extent, right? Because like a lot of the investors are actually able to hedge out some of their exposure, which creates some weight on the overall kind of directionality of the asset, right?
What's either your boldest or most contrarian take on can be specific token for, let's say, the next 12 to 24 months? Is there any big names you think they're not going to make it? Is there
Contrarian. I think in maybe taking like recent events, I'm not. I think there's a lot of path dependence. Path dependency is very important in life, right? Everything, and it's especially important in crypto. I think Luna launched at the right time and really got traction at the right time in like a huge bull market, right? And maybe time will tell, but maybe they'll be able to reach escape velocity in time before everything comes down, right? And I'm hopeful for that. But I think as you have other ones kind of copy in, and this is probably not that contrarian, but like Near, for example, right?
Near, yeah.
I'm way less bullish on them, able to kind of pull out the same thing, because they're launching in the middle of a bear market.
Correct.
And there's just way less capital and hype and everything around it. And that kind of, there's a cost to that, right?
Yep.
And so, hype and bull market and capital and everything, all of that can support mistakes or problems or a balance sheet. But in a bear market, things can come down, very, very quickly. And so we'll see. But if macro weakens further, it could be, again, pretty, get very interesting. So
one last question for you. Earlier, when we first started, on the background, you talked about how you left traditional, trading because you felt that you didn't want to sit in front of a screen the whole time and trade. And I'm asking this question because like I felt this myself too. I wasn't trading professionally at the time. I was trading pretty much. I traded my way through college. I started in like 2012, and then by 2016, I kind of got tired of it. I was like, all you're doing is like moving money from left to right. Yeah. And I started a startup. Back then it was like crowdfunding. What motivates you now? And kind of like what's your why behind trading?
Yeah, I think. Well, one advice, and I actually credit, CMS for saying this recently on their Twitter. I think it was Dan, right? He was saying like, if there's one piece of advice after trading like for 12 years, is that don't become a trader, go build something, right? And I do recommend everyone young to try at least to go build something. And yes, like we are building something. We're building, a firm, right? We're building a fund, whatever you want to call it. But I recommend people to build something, I want to say like tangible in a certain sense, like, build a project, or at least, try a project and do something that you can kind of see and have like a customer basically, right? I think that adds a lot of perspective. And you can always come, like, the market will not disappear, right? You can always come back, you can always be a trader, but try something different if all you've done is trade. In terms of what motivates me now, I think a lot of it, honestly, like, look, we've been in the markets for a long time.
Yeah.
You can probably retire if you wanted to. Yeah. I can probably retire if I wanted to, right? Like, it's not like I'm going out there and trying to buy like a yacht or like a bunch of like mansions, right? Like, that's not really what
it's a bear market after all.
Yeah. So like, what really motivates me actually is probably like all the friends and like honestly like the employees like that I've kind of like, my mantra has always been, I want to work with my friends, and I really try to hire like my friends over time, because when I'm like 80 or 90 years old, and like I have a fiduciary duty, sure, but like my friends are also very, very smart, and so I think like they're actually the right people to hire. But like when I'm like 80 or 90 years old, I'm looking back, like I think it's more about like the experiences, the memories, and everything, and like crypto's a 24/7 grind, and like if you can't do it with people that you like, it's just like, it's terrible. Like, it really like screws with the psychology. Like 2018, it was just me and Johannes. I love Johannes, but like, wow, like that was like lonely, right?
Yeah.
So after learning that, I was like, hey, like never again. I'm gonna like, next bear market, I need to well, one is build for you're always building for the bear market because you know it's always coming, and then two, like just hire and surround yourself with people that you can collectively get through like the toughest, the tougher times, right? And so for me, it's really like I want to make sure like, I kind of see like LedgerPrime, it's almost like a stepping stone for a lot of the employees, right? I don't expect them to be here for the rest of their life. I don't expect them to be there for like 5 or even 10 years, but I'm hopeful that I can build a platform for them to eventually use their experience and what they've learned, whether it's money or like their exposure or brand or whatever it is, to eventually start their own company, right? Or start their own project or go to something bigger and better. So I think that is what motivates me, on a day-to-day basis, is like, hey, like I have like a bunch of friends that I've hired, and now, we got to collectively like do something together. And, that's, I think, ultimately like what I find more pleasure in doing than, just trading behind a screen, right? So
I love that. No, I mean, it's what it made me think of is that I've heard more great things come from ex-Goldmans than Goldman, and if you can build such a brand where your former employee base is behind so many incredible, I mean, whether it's Joseph Lubin, Ethereum and whatnot. I mean, I think crypto's littered with it. Mona from Avantgarde, I believe, she ends on finance. She was also at Goldman, right? So like, where you build such a legacy in the team, the people you bring up, so to say, that's incredible. And even now, I spent more time myself thinking about that as I'm hiring more, growing the firm more. It's actually incredibly fulfilling, being able to impact people's lives in a meaningful way, because I know we all love to, like, let's say influencer culture of the last few years has been like, oh, I'm impacting 1 million people's lives, but how much are you really impacting them?
Right.
There's the people that you work with on a daily basis, you generally have a much deeper imprint on, and I think that's meaningful. Where can people find out more about you? Should they find out more about you? How do you want them to learn, reach out?
I should really tweet more. Maybe I'll start doing that. But no, just check out LedgerPrime. Talk to my wonderful like employees who are way more public than me, and should be. And yeah, I'll try to do more like podcasts and speaker stuff. But honestly, like at this point, like I'd rather, people from my team do this. So
amazing. Well, I'm glad I was able to steal you and, get a couple, gems and nuggets from you, because, I think it's the people that should be on podcasts more often aren't, because they're busy. And then the people that are on podcasts all the time, they're there because they have nothing else to do and they're just building a brand. So I'm glad we had this.
Yeah.
So.
No, thank you so much for having me. This is definitely like the best experience I've had.
Appreciate you, my man.
All right. Thanks.